earn more money but too busy to start a side hustle? Do it the right way and teach your money to make more money for yourself, even when you're asleep. Dale Corpus will show you just how here on the School of Cash Flow. With his entrepreneurial mindset and extensive experience in real estate and finance, Dale will help you become a responsible, strategic, and passionate passive real estate investor. Learn how you can increase your earnings or find more ways to make money, only here on the School of Cash Flow.
Hi, everybody, and good afternoon. Welcome to the School of Cash Flow. I'm the host, Dale Corpus, and this is my second episode of the podcast. So my guest today is my good friend, Todd Sulzinger, who is the CEO of Blue Elm Investments. So he's also a former Silicon Valley executive turned real estate investor with a focus on the growing niche of mobile home park investing. And his company has built the expertise to turn neglected mobile home parks into vibrant communities, increasing the availability of safe, clean, and affordable housing for the residents while offering their investors a strategic way to diversify their portfolios. So I'm really excited to have you, Todd, on this show because I too love mobile home parks and I invest in them passively myself. So Todd, thank you for taking the time to be with me on this episode. How are you?
Fantastic. Honored to be here. Thanks, Dale.
Yeah, absolutely. So, one of the things in your bio that I wanted to even first talk about was the fact that you used to be in corporate America as a finance executive, and now you're a real estate investor. Like, what was that transition like?
Well, I took a path like most people do, graduated from San Jose State University, a degree in finance, started working for a variety of technology companies, and just kind of was going to plan on going down that path. I hadn't really thought to do otherwise. And then I actually had kind of an epiphany with one of my first neighbors that I had after I bought my first house. And I mentioned it, I relate this story in a book that I was recently in called Success Habits of Superachievers. And this guy lived a couple doors down from me, real mild-mannered guy, kind of drove a beat-up car, had a toupee, didn't dress great. But the more I got to know him over the several years we lived next to each other, I would just slowly find out about all the things he'd invested in. He just mentioned about driving down the street to look at his rental property. And then he'd say, oh, got to go look at my strip mall over the hill in Santa Cruz, and talked about apartment buildings he owned. And I thought, wow, this guy doesn't work. He's got millions of dollars of real estate, but again, real kind of a millionaire next door kind of guy. And it really got me thinking about, is there a way to, starting to invest in real estate? So started listening to podcasts and, reading books and just trying to figure out a way to get into it. It's challenging in the Bay Area to jump into that, to jump into buying real estate just because the prices are so high here and the returns aren't great. So through the real estate guys, the real estate guys, Robert Helms and Russell Gray, they used to live in the Bay Area and they had a local meetup, and I used to attend those. And I met a guy who was building turnkey homes for investors in Dallas. And so I ended up taking a field trip out there with Russ and Robert and touring neighborhoods, meeting property managers and brokers and insurance agents and kind of everybody, the team you need to build around a good investment property, and ended up diving in and buying some single family homes in the Dallas Fort Worth market.
Awesome. And then how did you do the transition then to mobile home park investing?
Sure. Yeah. So that was kind of part of that story. It was like, oh, okay, I'm going to slowly buy, a bunch of single family homes, eventually be able to replace my W-2 income and become a full-time investor. And then after investing for a few years, I just realized how long that was going to take, that for every house I'd want to buy, I'd have to save up $20,000, $30,000. And, with the debt, maybe the cash flow was couple $100 a month. And while they were good investments, and producing good returns, it wasn't going to get me to that point. So also through Robert and Russ, I started, went to a few of their syndication training events. So for your listeners who don't know, real estate syndications are essentially pooling people's money together to buy bigger assets. So there's businesses around that. And when I relate that kind of concept to people, I think if you drive around anywhere near where you live and you see a big apartment building or a hotel or a big shopping center, it's not owned by one person. It's not like somebody just comes up and writes a check and buys the building. It's usually a group of investors. It could be a group of active investors, or it could be one or two people running the project and a bunch of passive investors going in to invest. So I started to learn about this syndication concept and went to some of the real estate guys training and decided I wanted to build a business around that. I had a great career in finance, got to travel the world, work with a lot of great people, but I just wanted to have a little bit more control over my destiny running my own business, and knew that I could combine my finance background along with my passion for real estate and build a business doing real estate syndication. So once I decided to do that, it was a matter of trying to find the right asset class that I wanted to put together deals in. And through kind of a couple of year process, looking at apartments, self-storage, groups of single family homes, as well as mobile home parks, I decided to zero in and focus in on those. And in 2019, actually ended up buying the first parks through a real estate syndication that I put together in Georgia.
Okay.
And then kind of, the transition, I was fortunate enough that the medical device company that I was working for down in San Jose allowed me to cut back to part-time. So it was like, full-time startup, crazy hours, long commute, all that. But I went to the CFO and just told him, hey, I really want to try to focus on building this business. I want to cut back to 4 days a week. Is that possible? So fortunately, I was able to do that. So I was able to have not just a hard cutoff to say, hey, I'm just going to quit today and jump into this. I was able to shift down to 4 days a week where I could at least spend a day a week looking at deals, talking to investors, all those things I need to do. And then did some consulting work for that company and for a couple other companies after that. So it was more of a slow transition versus a kind of a hard, hey, I'm just deciding to, quit what I'm doing and jumping into this.
Okay. There were so many other asset classes that you could be looking at. I mean, it looks like you were also considering potentially multifamily,
right,
and not. It's like, for you, like, why mobile home park investing? Why did you go that route?
Well, I guess first off, I wanted to do something a little bit different. I felt like there were so many people out there offering apartment syndications, and so much competition in that space from a acquisition standpoint. So I was looking for something to differentiate myself a bit. And then also I'd been learning a lot about mobile home parks through books I've read, other podcasts I was listening to, some other operators that I became friends with. And I was really intrigued by that business. And it's got a couple things that I liked about it better than apartments. One was mobile home parks are typically recession resistant because a lot of the parks that I purchase are in the affordable housing range. So that's one of the things that's nice about mobile home parks. The other kind of interesting thing about them that's different than any other multifamily asset class is it's the only asset class where there's a decreasing supply every year. So you've got hardly any new mobile home parks are actually being developed or built in any particular year, usually because of zoning, kind of a not in my backyard attitude. And then oftentimes they're being redeveloped for better use. So it's whereas there's always new apartments and single family homes being built across the country every year, there's a dwindling supply of mobile home parks. So kind of that, dwindling supply, but increased demand for affordable housing. I found that to be attractive. And then also there was just kind of less competition in that space. The mobile home parks can be a little bit different to manage and underwrite and understand compared to apartments. So there was less competition. As much as there's been an increased focus on this niche in the last few years, it's still not as popular as apartments. So less competition was great. And also kind of a greater ability to find seller financing. A lot of times these parks are owned by people that have owned the parks for a long time. They may still want to have income coming in, but they don't necessarily want to take the big capital gains that when they sell the park. But they also don't want to continue to run it day to day. So there's oftentimes ability to get good seller financing on parks, which is actually one of the things I was able to do with the parks that I bought in Georgia. So that's one of the, I guess, few benefits I liked about mobile home parks compared to the other asset classes I was looking at.
In terms of like you were getting into the mobile park investing business, how did you even find your first deal?
Well, I was, talking to a lot of brokers. There's a few brokers that specialize in mobile home parks, and then other commercial brokers that sometimes get listings. So I would just look at hundreds of deals, underwrote lots of deals, looked at a lot of different markets. I ended up hiring a mobile home park consulting company that I'm actually now working for. And I hired them to help me with the due diligence and turnaround effort for the parks that I purchased. So they also had access to some off-market deals. So I just looked at lots of deals and quite a few different markets across the country, and actually through a mobile home park broker found these two parks in Georgia.
Okay. I found it interesting that you also said that you were able to get seller financing, for some of your mobile home parks. Mm-hmm. So were they more favorable terms on the seller financing versus what you would get directly from another financial institution? Is that why you went that route? Mm-hmm.
Well, sometimes seller finance can happen for a couple of reasons. One, it could be that, again, the seller doesn't want to take a big capital gains hit, but still wants that income coming in. Okay. But oftentimes with some of these mom and pop run parks, they're just not run as professionally as, say, a similar size apartment somewhere. And oftentimes their financial records aren't as clean as you might find in a more professionally run operation. So in this case, the previous owner was only accepting cash from his tenants. Okay. Because he didn't want to report all the income. So you got that going on. So his bank deposits weren't going to match the rent roll, and the tax returns weren't going to match up. So those are kind of things that banks have a hard time with, just when somebody doesn't have clean financial records. So that's kind of an extra level of due diligence you have to have, in terms of you don't always know what you're going to get when you take over a property like that when the financials aren't clean. So when we first talked to the seller, he said, absolutely not. Don't want to do seller financing. You're just going to have to, figure out a way to buy it. Mm-hmm. But we found out through the broker that his parks had fallen out of escrow a couple different times in the past couple of years. Biggest reason being nobody could get a bank to finance it. So probably about halfway through the due diligence period, we really came to him and said, hey, we're serious about this park. We've got the resources to come in and turn it around. If you really think you're ever going to sell this thing, you're going to have to carry back a note on the property. Okay. So that allowed us to get pretty good terms. We got about a 35% down payment, which was, maybe higher than a higher down payment that you might get on a maybe more stabilized property that has cleaner books. But we got 8 years interest only terms, which was great for us too, versus an amortized loan. So, a little bit different than you get from the bank, but we felt really, really good about it.
Since that was your, in your very first deal, I'm curious, are there any lessons learned from that first deal that, you took into account when you did other mobile home park types of deals?
Let me see. I would say one of the things that we weren't able to do during the due diligence period was really get inside all of the park-owned homes. Okay. So in the mobile home park business, you've got some situations where the residents own their home and you rent the lot to them. Other situations where the park itself owns the home and you're renting it to them, similar to the way you rent a single-family home or an apartment. These parks had a majority of park-owned homes, and we were able to get inside some of them during our due diligence process, but not all of them. Mm-hmm. And after we took over the park, even though we got a written certification from the seller saying, no, there's no serious structural, plumbing, electrical issues inside the homes. After we took over, we found that it misrepresented the condition of the homes. So if I was going to do another deal with that many park-owned homes, I would just absolutely insist on being able to get in every single one to determine exactly what they look like. And if the seller can't accommodate that, then it's I would say worth walking away from the deal.
Okay, that makes sense. I mean, and then all these mobile home parks, they're all over the country. I mean, are there specific geographic areas that you focus on to find these? Or is it more so just based on the numbers, or both?
Yeah, well, I narrowed it down to probably, 10 or 12 states. I was looking for landlord-friendly states first off. So that kept me away from California, Oregon, New York. There's a large migration out to the Southeast. So I was looking in the Southeast. I was looking in Georgia, Kentucky, Tennessee, Florida, Alabama. So I restricted to a few different states, and then I wasn't trying to look in. I was looking in secondary and tertiary markets. I didn't necessarily want to go into one of the top metros just because mobile home parks in those markets are incredibly expensive, and those are super competitive. But in a lot of the research I had done, I'd found that in some of the smaller markets, there still can be a pretty high demand for affordable housing because there's, good manufacturing jobs in a lot of parts of the country. In smaller markets, you might have retirees, people on disability. And in some of the smaller markets, you might have, the mobile home parks might be one of the only places for affordable housing even in a town that might have 100 to 150,000 people versus a much bigger metro is going to have a lot more diversity in terms of apartments and other housing options.
Makes sense. Let me ask you this: what are the challenges that you see in this space, investing in mobile home parks?
Well, they're a little bit trickier to underwrite, I would say, and do that due diligence. In mobile home parks, they might be on city utilities, meaning they're hooked up to city water and city sewer. Other parks might have wells or septic tanks, or may even have their own waste treatment system. So those aren't necessarily deal breakers, but there's a lot more effort that would have to go into the due diligence to figure out if there's any issues with those in terms of some potential big capital expenditures that you may have to put into the park after you take over. So, it'd be rare that you would find a 100-unit apartment building that would have septic tanks, but in the mobile home park world, because they were often built on the outskirts of town, maybe outside the city limits, that they might be on private utilities. So that's something from a due diligence standpoint, people take a close look at. There are some investors that will say, absolutely has to have all city utilities, or they won't purchase the park. Other investors, again, depending on their level of experience and comfort, may say, hey, if it's got septic tanks and septic tanks are in good shape, or they were replaced within the last few years, or if the park's priced favorably enough that even if you might have to do some repairs on those or replace some of those a year or two down the road, you can factor that into your overall plan for the park.
When it comes to when you're doing your underwriting and determining if something is a good or bad investment, like what do you personally, look at to determine whether a mobile home park would be good to invest in or not?
Well, when I was doing my research, I was looking again for landlord-friendly states. I was looking for, places where there was a good, diverse employment background. The parks that I bought in Georgia are in this town called Milledgeville, which is about an hour and a half outside of Atlanta. And the town itself is only about 50 or 60,000 people. But once I dove in a little bit more into that market, I found out there was 3 colleges in town, and there was a Walmart and a Lowe's and several hotels and quite a few restaurants and several other smaller manufacturers kind of across a variety of industries. So from an underwriting standpoint, the market still has to be good. One of the metrics that's often looked at in mobile home parks is how close is it to a Walmart or Walmart supercenter, kind of with this idea that if Walmart's already done all this market research in terms of a population and income level around a certain market, that's that can be favorable. So there were some parks that I looked at that were 50 miles from a Walmart in a really small town. Mm-hmm. And to me, that would be just too risky if, knowing that if you had a tenant that left, that it would be harder to backfill somebody like that. So economic drivers are absolutely critical. And then I was looking for value add projects. So, which is something I think you find more so in mobile home parks than in the apartment world, where if it's not being run professionally, maybe it's being run by a mom and pop owner. They may not have kept up over time with rent increases or kept up with market rents because they may live in the park. They might be friends with the residents. They might, the park might be paid for, so they're not really concerned about maybe maximizing the NOI in the park. So I was looking for opportunities for value add, whether it be fixing vacant homes, rehabbing those and renting those, or taking advantage of vacant lots and bringing in refurbished homes into those lots, or finding parks that the rents might be far below market.
And for your mobile home park syndications that you've done in the past, I mean, do you have a certain exit strategy and time frame by which you plan on keeping that syndication going?
Well, I've done two deals so far. The one's in Georgia and another one in Tennessee. The Georgia parks, we planned for a 5-year exit, and the plan for that was to get the park stabilized, rehab vacant homes, do some infill on the vacant lots, and kind of slowly get rents closer to market with an expectation of targeting an exit after 5 years. The park in Tennessee, a little bit different situation there, where we have a 3-year plan to get the park to about a little over 50% occupancy, leave a little meat on the bone for the next owner to come in and take it to the next level. So that one we put together a 3-year exit strategy. So it does depend on the park and kind of where it is in the kind of value add turnaround phase.
Yeah. How active are you kind of in managing the day to day? It's like, do you do everything all yourself? Do you have a team that operates everything, or like where do you fit into the overall part of like the syndication model of
Sure.
For your stuff?
Right. So I had mentioned before that I'd hired this company, CCI Investments, who's a mobile home park consulting company. They work nationwide, managing about 85, 90 parks across the country. So they manage my parks as well. So I'm fairly active, probably more active than most owners, partly because they're turnaround parks and they need kind of more attention. Also because I have limited partner investors that I need to keep abreast of what's happening at the park. So they have a management team based here in California that is very active with the local on-site manager, and then I interact with both of them. I was on a phone call today with my primary contact for the property manager, just walking through several issues that are happening at the parks right now that just need either updates that I need to stay on top of in terms of what's happening at the park, or approvals for how we're going to deal with kind of any variety of issues that come up.
So if somebody wanted to invest in mobile home parks, a lot of these listeners already are active professionals, W-2 jobs, or own their own businesses, and they wanted to do this on the side, what would you recommend as ways they go about looking into investing into a mobile home park?
Well, I think passive investing is a great way to get into that space. I think I had invested in syndications myself before I started to put together my own deals. So I think investing in passive syndications is great because you get that diversification of deciding how you can put some money in mobile home parks, put in some apartment deals, put in some self-storage deals. So I think that's a great way to get into it. We have some other clients through the consulting company that I'm now working for who have decided to kind of jump in themselves. They bought, I helped a couple guys just themselves buy a park in Mississippi, and they wanted to jump in the business themselves. They found a park that was around about $350,000, $400,000, seller financing as well. So their down payment wasn't huge, and they decided they're going to jump in and kind of own the property themselves. And CCI will end up kind of taking care of the turnaround plan and managing it for them. So there is a way that some of our clients that have thought about investing passively have decided, hey, I'm going to go ahead and jump in and go ahead and own the park themselves and take advantage of the full upside around that.
So it's what state is that? What state was that mobile home park in? Out of curiosity,
it was in Mississippi, outside of Tupelo, where Elvis was born.
The interesting thing is, it's like you can't even get a 1-bedroom condo for $350,000 here in the Bay Area. Yet you
right.
A mobile home.
Yeah, and this was a 39 space mobile home park, probably about 60% occupied. So needs some work. It's going to need some investment to fix some of the houses, but once it's fully stabilized, it'll probably be generating 12, 13, 14%. So there's some good opportunities out there for people who want to buy parks that are neglected, not just 100% occupied, super clean, paved roads, kind of a beautiful park that you might only be able to buy that's going to give you a 4 or 5% return. There's a lot of other parks out there that just because of years of neglect, that maybe the previous owners haven't had the time or inclination or resources to turn them around. The right owner can come in, they can really make a big impact. And the thing that I love about situations like that is that, like in this park in Mississippi, these guys are going to come in and, fix up 10, 12 houses and provide, new places to live in this community where there's not any new development, because people aren't going into places outside of Tupelo right now and building a 50 or 100 unit B or C class apartment. There's the economics aren't there for that, but there's still a need for affordable housing, and these guys are going to be able to come in and provide that for people.
Okay. Since COVID has happened, has your outlook on mobile home park investing, has that changed? Has the asset class been affected at all by COVID? Mm-hmm.
It has been, and that's one of the things I was mentioning about some of the benefits of mobile home parks is recession resistancy. You can't say recession proof, because this recession here with COVID was different than others. Historically in a recession, there's going to be, people might go from A class apartments down to B, down to C class, and maybe people of two incomes have gone down to one, but there's kind of always this base at the lower end of the wage scale, whether it's, retail or hair salon or, light construction or lawn care, like, maids, things like that. Those were affected by this pandemic. So you had people at the lower end of the wage scale who would typically be, in this, affordable housing class, who haven't been able to pay rent or lost their jobs, combined with this eviction moratorium that's still in place. Mm-hmm. So like Georgia, for example, is typically a landlord-friendly state. And, the tenants all know that if you don't pay your rent, then, you're going to get a 3-day notice and you'll get evicted. So in states like that, it just makes people behave better. Once the eviction moratorium hit, we had this combination of people taking advantage of the moratorium because they knew they couldn't get evicted. And then we also had people whose jobs were affected by COVID. So I would say my parks have definitely been affected due to a combination of those things in terms of how people's have been affected, personally, as well as taking advantage of the moratorium. Okay. So it does depend on the park and the market and the tenant base. There's been, other parks and other markets where, in a situation where you might have this park where the tenants own their own homes, where they might be at risk of losing the house. Those have fared better during this recession because they don't want to lose their homes. And then again, other parks and other markets where people just, continue to make their payments because they're, responsible citizens and, or their jobs may not have been affected, or they're able to somehow kind of weather through COVID. So, I still feel positive and good about the asset class. This was just a, kind of a recession like no other.
Right. Yeah. And what advice do you have to someone wanting to get started, either investing in maybe a mobile home park syndication, or even getting like a small mobile home park outright themselves?
Yeah, I would say probably the big thing is to just try to educate yourself as much as possible. There's some good podcasts out there in the mobile home park space. I think just learning some of that terminology, just kind of understand that concept between like park-owned homes and tenant-owned homes and what that looks like. And then, if a passive investor is presented with a specific deal or investing in a fund, just to kind of be able to understand some of those, metrics in terms of, like I said, in a park-owned home, you're renting the house, in a tenant-owned home, you're renting the lot. So just kind of, I think getting used to some of that terminology is critical. And then kind of deciding, there's several operators doing mobile home park funds where they're raising money upfront from investors and then going out and buying parks. And then there's situations like in my case where I've identified parks, created an individual LLC for that park, and then raise money, and we're all limited partners, or we're all partners rather, in that LLC. So in the situation with my parks, people know, what they're getting. They're part of this LLC. They know the story about what they're buying. In the fund model, they're trusting that the operator will be able to, take the funds that have been invested and go out and find attractive parks for them to put into the portfolio.
Okay, that makes sense. I know that your main focus is in mobile home park investing. Are there any other asset classes that you also invest in, out of curiosity?
Yeah, one of the ones that I really like is mortgage note investing. I started investing in a fund probably at the end of 2017 with this company called American Homeowner Preservation, AHP, and I had heard about them on a podcast and did some research and due diligence on them, and I really like that the concept behind that company, and something that a lot of note investing firms have out there is trying to buy distressed mortgages from banks or hedge funds, but then working with the homeowners to keep them in their house. So it's this great model where you can go to a homeowner and say, hey, you're behind on your payments, you could get foreclosed on, but we can come in and restructure your mortgage at a lower balance than it was before, and we can keep you in your home. While at the same time, because the mortgages were purchased at a discount, it can provide a good return to investors. So I've been investing in that fund for a few years, and a couple other funds, and that's kind of, I like that model. It's great because it's backed by real estate, because it's backed by the mortgages, but the people that run the funds who know what they're doing, and it's complicated to do that in terms of what to look for and how to buy them correctly. But it's a good return profile for the investors. Less, usually no upside. So usually it's more of a fixed return. Whereas in a, let's say a mobile home park or apartment syndication, there could be potential for greater returns at the back end when you sell property. In the mortgage note world, it's more of a fixed income play. But to me, I like it because it's pretty solid. So I've been talking to several different people actually recently about possibly putting together a fund like that for my investors, just because it is something that I've been happy and had good success investing in myself, and I think that would be a good offering to put together for my investors.
No, absolutely. I completely agree with you on investing in mortgage notes. I do a lot of that stuff inside my self-directed IRA. It's a perfect
Yes.
asset class for that. So I'm with you 100%. Let's see. Next question is, how does somebody even invest with you?
Well, usually the first, let me see, the syndications that I put together, there's, for your investors that may or may not know, there's either syndications where you can bring in accredited investors where they have certain income or net worth requirements, or non-accredited investors that don't have those requirements. To bring in non-accredited investors, I would have to have a relationship with them, gotten to know them a little bit, them to know a little bit about me, learn a little bit about their financial situation. So the syndications I put together thus far have been what they call 506C, which lets me bring in non-accredited investors. So in that situation, it just takes, joining my investor club, and then us jumping on a phone call just to kind of, spend some time and, build that relationship between us to, again, let them know what my company, Blue Elm Investments, is all about, and understand what their financial situation is. And it's really based around the SEC, just wanting to make sure that somebody's not, just picking up a phone call from somebody and, taking their last $25,000 or $50,000 and putting it into a deal. There's got to be some work that somebody who's a general partner like myself putting deals together, wants to feel comfortable that somebody knows what they're doing when they're getting into an investment like that.
That makes sense. This is a general question, and it just deals with real estate investing overall. What has real estate investing done for your overall life? Now that you're not in the corporate world anymore, like what have you gotten out of real estate investing?
Well, I just finished my 2020 tax return, so tax benefits are huge. So, when you're working full time in real estate, you can claim real estate professional status from a tax standpoint. So that gives some huge advantages. But those also through my when I put my syndications together, I let those tax benefits mostly related to depreciation flow through to my limited partner investors. So depending on their situation, they can also take advantage of those as well. I think this kind of just a feeling of autonomy and, running my own business and, getting to come on shows like this and talk to you and, talk about ways we might work together has been fantastic. Getting a paycheck every 2 weeks from a company for 20 plus years was something that's, pretty easy to get used to and hard to break away from. So So there's certain parts of that I miss, but just having that independence of being my own boss and having real estate be a vehicle to do that's just been fantastic.
How can someone learn about you and your company?
Yes. My company is Blue Elm Investments. So they can find me at my website, www.blueelminvestments.com, blue the color, elm like the tree, investments, or Todd, Todd, at blueelminvestments.com. And if somebody reaches out and joins my investor club, I'd be happy to talk real estate, talk mobile home parks, and always happy to help educate and teach people about this space and what passive investing is all about.
Well, thank you, Todd. Thanks for coming on to this episode. And thanks
Dale.
Oh yeah, you're welcome. And providing value to my listeners and to my listeners, thank you for checking out another episode of the School of Cash Flow. Until next time, live life abundantly.
Thanks for listening to another episode of the School of Cash Flow. We hope you enjoyed our deep dive into all the tips and tricks you can use to help you on your passive investing journey. In the meantime, you may visit www.cashflowschoolpodcast.com for more great episodes. Don't forget to subscribe, rate, review, and share. That's all for this episode, folks. See you next time.